Hello dear traders, welcome to Insta TV. You're watching financial news with me, Anna Kasatkina. Japan's monetary authorities have long been struggling with the prolonged appreciation of the domestic currency. Apart from undermining the competitive advantage of Japanese exports on the overseas commodity market, the surging yen affects national consumer prices in an undesirable way. The latest set of statistical data released on Friday has confirmed a slowdown in Japan's inflation. The Japanese Consumer Price Index remained flat year-over-year in the first month of 2016 from a year ago. Analysts keeping track of Japan's economic performance had too expected inflation to drop to zero, further away from the 2% target set by the Bank of Japan. The Minister of Internal Affairs and Communications also reported unchanged core consumer prices for January. Consumer inflation, excluding volatile fresh food prices, showed no gain on a yearly basis. According to consensus forecasts, the market had anticipated a weaker reading, projecting a 0.2% decline in core CPI inflation. While speaking in Parliament, the Bank of Japan's governor pointed out that it was technically possible for the regulator to introduce further monetary easing. While the central bank's benchmark interest rate is already in negative territory, Haruhiko Kuroda emphasized that he did not see any limits to quantitative or qualitative easing. However, so far the Japanese policymaker does not see any compelling reason to cut interest rates again anytime soon. The Bank of Japan still expects inflation to reach the 2% target by April to September 2017. Meanwhile, traders pay little attention to the verbal interventions of the Japanese monetary authorities. Market participants are now in a rush to close short positions on the dollar-yen pair ahead of the upcoming Group of 20 meeting in Shanghai. The US dollar was worth 113 Japanese yen in pre-European deals. Finance ministers and central bank governors of the world's 20 biggest economies are expected to coordinate their monetary policies with a view to stimulate global economic growth. However, massive hedging activities in the currency market signal that investor sentiment is likely to be dampened by the outcome of the G-20 summit. This was Daily Financial News on Insta TV. Thank you and goodbye.